Hi friends. In today's video, I am going to tell you about a very interesting financial concept used by investors worldwide to ascertain profitability of a company. Warren Buffett, the multi-billionaire investor and businessman, has also spoken highly of return on equity, or ROE, as a key financial ratio in evaluating a company's performance. ROE measures the amount of net income a company generates relative to the amount of equity capital it has raised. If you like the content, do subscribe the channel and like the video so it may help the other people looking for similar information on ROE. ROE, or return on equity, is a measure of financial performance calculated by dividing net income by shareholders' equity. ROE is considered a gauge of a corporation's profitability and how efficient it is in generating profits. The higher the ROE, the more efficient a company's management is at generating income and growth from its equity financing. Let's see how ROE is calculated. ROE is expressed as a percentage and can be calculated for any company if net income and equity are both positive numbers. Net income is calculated before dividends paid to common shareholders and after dividends to preferred shareholders and interest to lenders. The formula is net income divided by shareholders' equity. ROE provides a simple metric for evaluating investment returns. By comparing a company's ROE to the industry's average, something may be pinpointed about the company's competitive advantage. ROE may also provide insight into how the company management is using financing from equity to grow the business. Let's understand this with an example. Let's assume there are two companies, Zach Auto and Mark Candy. Both Zach Auto and Mark Candy made a profit of $20 million this year. Each company has equity, the amount received from investors in exchange for shares. Zach Auto has an equity of $50 million. Mark Candy has an equity of $100 million. To calculate return on equity, let's divide each company's profit by the equity. By doing so, we get ROE for each company. ROE for Zach Auto is equal to 40%, and ROE for Mark Candy is equal to 20%. Even though the profit is same for each company, Zach Auto is more efficient at utilizing the equity to generate profit. Warren Buffett has stated that he looks for companies with a high and consistent ROE, as it is a sign of a well-run business that is able to generate profits from its equity capital. He has also stated that a high ROE is not enough on its own, and that he also looks at factors such as the stability and sustainability of the ROE, the company's growth prospects, and its competitive advantage. Overall, ROE is an important financial ratio that Buffett considers in his investment decisions, as it provides valuable insight into a company's profitability and efficiency in generating returns for its shareholders. Now let's see some of the advantages of return on equity. Measure of profitability. ROE provides a clear measure of how effectively a company is using the capital provided by its shareholders to generate profits. Comparison of companies. ROE can be used to compare the profitability of different companies, both within the same industry and across different industries. Indicator of financial health. A high ROE indicates that a company is generating profits efficiently, which can be a sign of strong financial health. Evaluate management performance. ROE can be used to assess the performance of a company's management and their ability to effectively allocate resources and generate profits. Investment decision-making. ROE can help investors evaluate the potential for future growth and make informed investment decisions. Simple calculation. ROE is a simple calculation that can be easily understood by investors and stakeholders. Let's see what are the limitations of using return on equity as a financial metric. Accounting differences. ROE can be influenced by different accounting methods used by companies, making it difficult to compare ROE across different firms. Short-term fluctuations. ROE can be affected by short-term fluctuations in earnings and equity, making it less useful for evaluating a company's long-term performance. Debt levels. High levels of debt can increase ROE, but may also increase financial risk. ROE does not take into account a company's debt levels and its impact on profitability. Limited scope. ROE only measures the return generated by equity and does not consider other sources of financing such as debt. One-dimensional measure. ROE provides only one dimension of a company's financial performance and does not consider other factors such as revenue growth, cash flow, or market position. Misuse of leverage. Companies may use leverage to artificially increase ROE, making it a less accurate measure of true profitability. At last, no one factor can tell the whole story of company's performance, and there are other factors that need to be considered before investing in a company. Do check the other videos on this channel to understand about various other factors used by investors to select a company. This brings us to the end of the video. Give a thumbs up if you liked the video and do subscribe to get a notification for upcoming videos. Goodbye and have a nice day.